This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Scrapping subsidies. The White House halts key payments to health insurers, leaving the industry and millions of Americans in limbo.
Business in Iran. The president takes a hard line on that country, decertifying the nuclear deal, and Boeing pays extra close attention.
What's new on Netflix? Well, the stock price. It hit a new milestone just as traditional media companies have headaches. Those stories and more tonight on Nightly Business Report for Friday, October 13th.
Good evening, everyone, and welcome. The stock market finished the week on yet another high note. The Nasdaq closed at a record. The Dow and the S&P 500 almost did. And even with a number of developments out of Washington, investors were focused on the possibility that corporate profits will be strong this quarter and that global economic growth will continue to improve. Today, the Dow Jones Industrial Average rose 30 points to 22,871. Nasdaq was up 14 to that record, and the S&P 500 added 2. For the week, all of the major indexes were higher.
The market may have risen even more today if not for the decline in the healthcare stocks. Shares of hospital operators and insurers were lower after President Trump said the administration will immediately stop making subsidy payments to health insurers that sell plans under the Affordable Care Act exchanges. Those payments are used to offset the cost of coverage for low-income people. And as Bertha Coombs explains, that leaves a lot of questions about what happens next.
President Trump says he's cutting off what he calls subsidies to health insurers.
That money is going to insurance companies to lift up their stock price, and that's not what I'm about. Take a look at who those insurance companies support, and I guarantee you one thing, it's not Donald Trump.
Those CSR payments, or cost-sharing reduction subsidies, are used by insurance companies to lower out-of-pocket costs for 6 million people on Affordable Care Act plans. The president's move won't make much difference for them.
Insurers will still have to pay for those subsidies, though, themselves, right? They're required to by law.
Without action from Congress, exchange insurers could have to absorb subsidy losses in the fourth quarter, which analysts say will hurt smaller regional carriers the most. But for 2018, with open enrollment set to start November 1st, most carriers have already priced in large premium increases to account for the loss of CSRs. Those higher prices will actually cost the government more than the subsidies themselves.
The effect of that will be the premium subsidies will also increase. The one thing that's kind of ironic about the effect of this is that it will actually increase the federal spending on low-income persons in the exchanges by about $365 billion over 10 years.
And the Congressional Budget Office expects because of those high premiums, we'll see an attrition of about 1 million people dropping out of the exchanges for next year. But the big question is what the insurers will do about the individual market beyond that.
At a certain point, you say, this market's just not worth it for me anymore. I'm going to sort of take my marbles and go to a more profitable market.
Insurance groups expressed concerns about the president's move and urged Congress to act in a bipartisan fashion to stabilize the exchanges. But as one analyst put it, with open enrollment just 3 weeks away, it's now going to be up to the states to try to shore things up. Bertha Coombs, Nightly Business Report, New York.
President Trump today refused to certify that Iran is complying with the terms of the landmark 2015 nuclear deal. He also described that country as a, quote, fanatical regime. Despite taking a hard line, the president didn't do something he repeatedly suggested he would do, namely scrap the deal entirely. Eamon Javers reports tonight from the White House.
President Trump announced he will decertify the Iran nuclear deal under U.S. law, but remain in the agreement, an action that means it'll be up to Congress to decide whether or not to reimpose sanctions on Tehran.
As we have seen in North Korea, the longer we ignore a threat, the worse that threat becomes. It is why we are determined that the world's leading sponsor of terrorism will never obtain nuclear weapons.
The president was critical of the deal cut by his predecessor, an agreement he has called one of the worst ever.
By its own terms, the Iran deal was supposed to contribute to regional and international peace and security. And yet, while the United States adheres to our commitment under the deal, the Iranian regime continues to fuel conflict, terror, and turmoil throughout the Middle East and beyond.
By keeping the deal in place, despite his harsh criticism of it, the president is walking a fine political line.
I think that this was a nod to Secretary Mattis, to Secretary Tillerson, and to General Kelly, all of whom think that the keeping the agreement in place is in the national security interest. The president felt more strongly in the other direction. This, to a certain extent, is a compromise among these men.
Reaction among American allies was mixed. A joint statement from the leaders of France, Germany, and the United Kingdom said, "We encourage the U.S. administration and Congress to consider the implications to the security of the U.S. and its allies before taking any steps that might undermine the nuclear deal." But Israel's prime minister was more effusive in his support of Trump's approach, saying if the Iran deal is left unchanged, one thing is absolutely certain. In a few years' time, the world's foremost terrorist regime will have an arsenal of nuclear weapons, and that's a tremendous danger for our collective future. As the president spoke, the Treasury Department announced new sanctions against Iran's Revolutionary Guard and 2 other Iranian entities. The president said that in the coming months, he could announce new sanctions or tear up the nuclear deal altogether. For Nightly Business Report, I'm Eamon Jabbers at the White House.
And Boeing is one of the big Western firms that started doing business in Iran following the signing of that deal a couple of years ago. And it says its plan to sell 80 passenger jets to Iran Air appears to be safe for now. Boeing also has aircraft purchase agreements in place with other Iranian carriers.
Social Security recipients will get a 2% increase in benefits next year. That amount is up sharply from the past 2 years, but lower than what was projected this summer. The adjustment covers more than 61 million beneficiaries and is the highest since 2012. The rate of increase is tied to the Consumer Price Index, a commonly used inflation gauge.
And that inflation gauge was higher for the month of September. The Consumer Price Index rose 0.5%, the second straight increase and the largest in 8 months. Now, most of the rise came from higher gas prices after Hurricane Harvey knocked refineries offline.
The rise in gasoline prices also contributed to higher retail sales, which saw the biggest increase in 2.5 years in September. There was increased demand for building materials and cars following the hurricanes Harvey and Irma. Retail sales are expected to pick up in the holiday season, and some are forecasting the strongest holiday season in years.
And higher sales tend to correlate with higher or better consumer sentiment, and that is what was reported today. The University of Michigan survey said sentiment unexpectedly hit a 13-year high this month as Americans' perception of the economy and their own finances rebounded.
The vice chair of the Federal Reserve today said he expects the central bank to stick to its schedule of interest rate increases, which includes 1 in December and 3 next year.
I think that's achievable if we continue to run good policies, and with the global economy coming up, and for the first time in a decade having faster growth in the global economy than we expected, there's a good chance of that.
On his last day as vice chair of the central bank, Mr. Fisher also said Janet Yellen should be reappointed as Fed chair and warned against too much deregulation of the financial sector.
On Wall Street, shares of Netflix broke $200 a share, though they failed to close above it. It's the first time the streaming services stock has reached that level. And as Julia Borston reports, it comes as traditional media companies stumble.
Netflix is expected to keep growing and growing and growing. Goldman Sachs and JP Morgan both raising their price targets on the stock on expectations that the company's recent price increase will boost revenue and its investment in content will pay off. Despite the stock nearly doubling over the past year, investors think it can go even higher.
I don't think valuation is a consideration or a reason not to buy Netflix here. If it has rising revenues, the earnings are going to catch up to it.
Netflix projected it would add 4.4 million subscribers in the third quarter, and analysts expect the company to pick up more than 6 million subscribers in the fourth quarter. While Netflix soars, traditional media stocks have been under pressure, with growing concerns about consumers cutting the cord and the diminishing value of the TV bundle. AT&T warned it would lose video subscribers in the third quarter, pointing to intense competition in the TV market and the impact of hurricanes. AT&T added 300,000 subscribers to its new streaming service, DirecTV Now. But even that growth couldn't compensate for traditional TV losses. And cable distributor Charter is in a standoff with cable giant Viacom over renewing their distribution agreement. After moving lower yesterday, shares bounced back today. Analyst Barton Crockett saying concerns are overblown.
You look at the pressure on the TV network stocks, and I think more for some of the others, like a Viacom or some of the TV station companies, things have gotten to silly land. I mean, the market is treating some of these equities like there's zero equity value.
When the traditional media giants report over the next few weeks, we'll see what kind of boost they get from new digital revenue, such as from AT&T's DirecTV Now. And we'll see how much competition from the likes of Netflix has hurt ratings and ad dollars. For Nightly Business Report, I'm Julia Borston in Los Angeles.
So let's turn now to Robin Dietrich for more on traditional media companies and how they're doing in this digital landscape. She's senior media analyst at Edward Jones. Welcome. Nice to have you here, Robin.
Thank you. Good afternoon.
Let's start, first of all, with what you think the key is for the traditional media companies to continue to succeed and to continue to compete. Is it as simple as content or not?
Well, we certainly are in a period of a lot of uncertainty for these media companies for the last several years. We do think it does come down to content for some of the companies that really have the best content. That is really going to be the way that they survive in a digital world, because whether or not more consumers are moving to digital, to mobile, they would be able to take that content and either sell to other providers or even offer their own service. And we see more and more companies doing that. But you can't do that unless you have enough really popular content to create your own service.
Robin, I noticed that there's been a lot of consolidation in this area, and I suspect that you would see that is an ongoing possibility. Discovery and HGTV, AT&T and Time Warner, and many, many others. Right. Comcast, which owns the company that produces this show, bought NBC. Do you see consolidation as a way forward, and who will be the mergers and the mergees?
Yeah, I mean, I think that is a sign of the times that we're in because of the uncertainty, because of the need to, have leverage in this very dynamic, changing marketplace. Some of these companies are too small to survive, and I think that's why we saw some of the mergers we have already. So, certainly, there are, thoughts that really any of these companies could be acquired, and more of the mergers between the distributors, like the cable companies and the AT&Ts and Comcast, and the content companies. I think that is something we're going to continue to see, as well as potentially what's been long thought about has been some of the tech companies getting involved and making some acquisitions.
It also comes down to pricing power, does it not? The better the content you have, the wider the reach you have, the more pricing power you have. Is that a correct read?
Yeah, and that's always been the case. The bigger, the better content. That's given these companies, in the past, always better negotiating leverage with the distributors out there, and that's really, we think, still going to be the case.
Do you have a favorite stock or two?
The only company we recommend right now in the media space is Disney, and that is really because of how diversified they are. We do recognize the pressures in the media industry, and for ESPN in particular, and that's their the flagship of their media business. But over half the profits come from the studios, the theme parks, and places that are really doing very nicely for Disney, and they're investing a lot in those areas. So we like the valuation on the stock. We think that some of this concern over media is perhaps creating somewhat of an opportunity for the long-term investor.
All right, Robin, we'll leave it there. Thank you so much for joining us. Have a great weekend. Robin Dietrich with Edward Jones.
Still ahead, a sweet deal. Will there be a get-together in the chocolate business?
IRS has suspended its $7 million contract with Equifax. The agency said it's putting the deal on hold as a precautionary step. As we reported yesterday, Equifax had to take down a web page after a security analyst said he was targeted with malicious ads while visiting the site. About 145 million Americans may have had their personal data exposed when Equifax was suffering a security breach.
Shares of PG&E fell today and have had their worst week in 9 years on reports that downed power lines may have played a key role in the deadly fires spreading across Northern California. State officials now investigating some power lines that were knocked down by a windstorm on Sunday. Regulators also looking into PG&E's maintenance operations and told the utility to preserve any evidence related to those fires. Shares of PG&E tumbled 10% on the session today. The stock is off 16% this week.
Legal costs eat away at Wells Fargo's earnings, and that's where we begin tonight's market focus. The bank reported a drop in revenue and profit, saying that results were hit by a $1 billion charge related to investigations of the bank's mortgage lending practices before the financial crisis. The pre-crisis mortgage issues are in addition to the fake account scandal that has embroiled that company over the past year. On a positive note, though, the bank saw stronger loan growth in its residential mortgage business.
In mortgages on balance sheet for prime jumbo mortgages, a lot of demand and good growth in that area. Commercial real estate, we're the biggest commercial real estate lender in the U.S., and we've been relatively flat there. It's a very competitive market.
Shares fell nearly 3% to 53.69. Bank of America beat analyst sales targets despite reporting a drop in trading activity in its fixed income business. The bank said higher interest rates also helped push profits above expectations. The shares finished the day up about 1.5% to $25.83. And Hostess Brands chief executive Bill Toller unexpectedly announced that he will be retiring in March. The news caused financial firm UBS to downgrade the company's stock, with UBS saying that Toller is the driving force behind the Twinkie maker's success, and his departure raises some concerns. Shares of Hostess finished the day down 11% to $11.94.
The company Optinose, which, as you might guess, makes medications for the ear, nose, and throat, went public on the NASDAQ today. The pharmaceutical company offered 7.5 million shares at $16 apiece. Shares jumped more than 18% in their debut, closing the day at a fragrant $19 for Optinose. HP gave profit guidance for 2018 that was ahead of street forecasts. The technology company also hiked its quarterly dividend by 5% and said it plans to issue 50 to 75% of its free cash flow to shareholders through dividends and stock buybacks. Shares were 6% higher at $21.71.
Samsung forecasting record third quarter operating profit thanks to strong results from its memory chip business. But that was overshadowed by the surprise resignation of Samsung's chairman. Kwon Oh-hyun, who has been the face of that company since its de facto chief was sent to prison on corruption charges, will step down next year. His resignation deepens concerns over a leadership vacuum at that company.
Shares of steel makers rose today after a Japanese steel company admitted to misleading hundreds more customers than originally thought. The latest disclosure doubles the number of affected companies to 500 now. Kobe Steel said some of its products lacked proper quality inspections and that problems existed with some products for more than a decade. General Motors, Toyota, Boeing, just some of the companies that have used Kobe Steel products. And that, along with reports of strong imports of iron ore from China, sent shares of U.S. steel companies higher, as you see there.
Saudi Aramco is reportedly considering shelving its IPO. According to the Financial Times, the Saudi oil company has struggled to select an exchange where to trade its shares. New York and London have been considered the frontrunners for the largest ever flotation of stock. Saudi Aramco is instead looking into a private share sale to the world's largest sovereign wealth funds and institutional investors. Other reports say that Saudi Aramco's IPO will not be pulled, just delayed.
Well, there could be a deal in the chocolate business. Hershey reportedly preparing to submit a bid for Nestle's confectionery business. Leslie Picker has been following the story for us. This is a sweet one.
Hey, Tyler, it
Had to say it.
absolutely is. It's a good one. It makes me hungry this Friday evening. This is the Butterfingers, Baby Ruths, Laffy Taffies. That's the U.S. confectionery business of Nestle. Now, that has been up for sale since about June. The company announced that they would look for strategic options for that business. Now, CNBC.com has exclusively learned that potential buyers could include Hershey's, Ferrara, which are two separate companies, as well as private equity interest for this business. Now, according to people familiar with the matter, the value for this business could be as much as $2.5 billion.
Do we have any idea who the front runner might be? I mean, $2.5 billion, it's a lot of money, but those are a lot of very popular brands with a lot of depth in terms of penetration.
Absolutely. So $2.5 billion is at the high end. Apparently, the bids are coming in between 2 and 2.5. Now, it's usually up to the company to choose the highest bidder. Those bids were submitted today, so I think they're still going to be sifting through and figure out exactly where the bids are, what they're offering. It could be a mixture of a bunch of different currencies, stock as well as cash, in terms of how they're going to purchase this thing. So those are all the types of things that Nestle is going to have to sort out when it decides who the ultimate bidder will be.
If it's Hershey, they'll seal it with a kiss, right?
Oh,
now,
that was a good one.
I'm curious as to why Mars, you didn't mention Mars in there. Now, Mars is a very, very secretive company. Maybe we just don't have the reporting on that. Is Nestle going to hold on to other confectionery businesses in Europe, for example, or is this it?
So this is part of the plan by Nestle that it announced in June, which was due to pressure that it's facing from an investor who said that they need to improve their margins, they need to streamline their business a bit more. So they will still hold plenty of businesses, plenty of food businesses over in Europe. This is U.S. specific, and these are the U.S. brands that they've decided that they could achieve a much better valuation in a sale, largely due to consumer taste. I mean, these are all brands that we know and love, but do we eat Laffy Taffies on a daily basis anymore? I mean, maybe Halloween time we do.
I was going to say, it's the time of year.
It's a good time of year to sell.
It's a good time of year to sell it.
If you're getting ready to sell. Well, I can see the headlines, Butterfingers and kisses.
Oh, there we go.
Leslie, thanks.
Thank you, guys. You're on a roll tonight.
Oh, baby, it's the weekend.
Thanks, Leslie.
Thank you.
Coming up, stuck in the middle. Are you part of the middle class? Well, the answer depends on where you live.
And here's a look at what to watch next week. On Monday, the video streaming giant Netflix will report financial results. They come after the bell. On Wednesday, the Federal Reserve will release my favorite book of all, The Beige Book. That is an aptly titled anecdotal look at economic conditions in the U.S. And on Friday, we'll find out how much new home construction took place in September. We get the release of housing starts. That's what to watch next week.
The head of JP Morgan Chase does not like the cryptocurrency Bitcoin. He made his feelings clear in September when he called it a fraud. Yesterday, on his company's earnings conference call, he said he wasn't going to talk about Bitcoin anymore. That is until today, when he made these comments at a conference at the Institute of International Finance.
Bitcoin hit a new high today.
I could care less what Bitcoin trades for, how it trades, why it trades, who trades it. If you're stupid enough to buy it, you'll pay the price for it one day.
There you go. He also called it a great product for criminals, but added that he thinks the blockchain technology behind Bitcoin is valid.
The White House has promised an historic tax cut for America's middle class. House Republicans go along with that, but whether you fall into that category is a matter of some debate. Robert Frank looks at what it means to be in the middle.
House Republicans are considering a new plan to allow the middle class to continue deducting their state and local taxes. The question now is, what is the dollar definition of middle class, and does it depend on where you live? In the face of opposition from high-tax states like California, New York, and New Jersey, House Republicans are proposing to eliminate state and local tax deductions for the top earners, but allow the middle class to keep them. Now, the new battle is where to draw that income line. The median income in America right now is around $59,000 a year. Of course, 59,000 goes a lot further in Illinois and Minnesota than it does in New York or Massachusetts. Representative Peter King of New York says the cutoff should be $400,000 a year, saying that's what counts as middle class in his high-cost district of Long Island. According to census data, the median income in New York is $61,000. In Massachusetts, it's $74,000, and in Illinois, it's $57,000. Iowa, it's $52,000. An analysis from the Pew Research Center finds the upper bound of middle class varies even more widely. Being middle class in New York State stops at around $112,000. In California, it's $120,000, but in Mississippi, the upper bound is $75,000. Alabama, it's $85,000. Now, all of this matters because the higher they raise the income threshold, the less revenue they get from eliminating the tax, showing yet again how fixing one tax problem often creates another. For Nightly Business Report, I'm Robert Frank.
On Friday, as you know, we usually bring you our weekly Market Monitor segment, but as luck would have it, on this Friday, the 13th, we ran into technical problems. You can still, though, find his stock picks on our website, nbr.com. I never believed in that, but today there's been a lot of glitches. Anyway, we hope your day was glitch-free. That's Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And happy Friday 13th, everybody. I'm Tyler Mathisen. Have a great weekend. We'll see you Monday.